The security market line is the graphical depiction of the capital asset pricing model equation. So here I have expected return on the vertical axis, and I have beta on the horizontal axis. And you can see that here I have the market portfolio. Here's the expected return of the market. And here I have the risk-free asset. That's my intercept. And this line, this return line, is a function of beta. And it's a line with a slope of this amount. And you can see that when I get to a beta equal to 1, when beta equals 1, I'm earning the expected return of the market, and this is the market portfolio. And so just to review all of our lines, the capital allocation line to the capital market line to the security market line, this is where we are now, the CAL to the CML to the SML. Remember, the capital allocation line has total risk on the x-axis and some subset of tradable assets, so the portfolio is P. The capital market line also has total risk on the x-axis and all tradable securities, so the portfolio is M. The SML, or security market line, has all tradable assets, so the portfolio is M, but now we just have beta on the x-axis. And so it's the graphical depiction of the CAPM. Here's that equation again. The risk-free is the intercept. The slope is the expected return of the market minus the risk-free, the risk premium of the market. And here's the point. The capital asset pricing model theory says that in equilibrium, all stocks, all tradable assets must lie on the security market line. And because the expected return is only a function of beta. And if it is the case that I can somehow find a security that somehow is expected to earn more, then this is a disequilibrium and I can profit from this. So let's look at some of the extensions of the CAPM using this. So we're going to look at alpha, and we're going to look at before alpha, and we're going to look at after alpha. We've already looked at after alpha a little bit when we did that McDonald's regression, but let's look at it now. So here's the idea, is that I use security analysis, not CAPM, to compute some expected return for some stock I. I look at the expected cash flows, sales, costs, EBITDA, some sort of value, and I find that the computed expected return that I just came up with using security analysis exceeds the CAPM expected return. And this is a function of just the beta, the risk-free, in the market. So therefore, this stock is underpriced. And we would refer to this difference as the ex-ante, or before alpha, and would be depicted as a dot above the security market line. The idea being that eventually the stock must return to the securities market line when people realize that the stock is therefore underpriced. They will buy it, the price will go up, and if I've already bought it ahead of time, then I earn extra return. So here's an example. The expected return of the market is 14%. The risk-free rate is 6%. If the beta for this stock is 1.2, then I would expect it to earn 15.6. But if, using security analysis, I think that the stock will actually earn 17, then the alpha, this ex-ante before alpha, is equal to 17 minus the 15.6 is equal to the 1.4. And the theory says that eventually the rest of the market participants will realize that this stock is earning more than it should. They will buy the stock. This will cause the price to go up and the return to go down until the stock, like all stocks, lies on the security market line. Note that I have a beta that is greater than 1, and so I'm to the right of the market line with a return higher than the market. The other way that people look at alpha is the ex-post alpha, or the after alpha. And here what you do is you regress the historic RI on RM, which is exactly what we did with McDonald's. And here's my regression equation. If I get a positive and significant alpha, then over the period, this stock, and if it's not a stock, if it's a portfolio, maybe it's the manager or the fund, earned a positive risk-adjusted excess return. We would say that this fund beat the market. And so here's a figure from the text, and it's estimates of individual mutual fund alphas from 1972 to 1991. And this plot is the frequency distribution of the estimated alphas for all equity mutual funds with a 10-year continuous record. And you can see that, we'll have to visualize this because we don't have any statistics, but you can see that this thing seems to have sort of an expected value of 0. And even though we do observe some positive alphas and negative alphas, it seems as if most of these alphas are 0. Okay, the next thing we're going to do is we're going to think about this idea of liquidity. So an extension of the capital asset pricing model recognizes that you may earn more if an investment is illiquid. So I'm going to add something to the expected return on the CAPM to account for illiquid assets. And that's going to increase the expected return by some factor, by some function for liquidity. And so FCI accounts for the fact that there is some trading cost for a stock, and that could either be a price hit, generally it's a price hit. So investors require a higher return for liquid assets, and we would have this be a trading cost, and this would be a function of a trading cost. It's likely concave because so it means it increases at a decreasing rate because people will hold illiquid stocks for a long time to amortize costs. And so the higher the trading cost, the further to right on the x-axis, but the extra amount added to the expected return increases at a decreasing rate. And so we would have some extra factor, but it's not a linear factor, it's not a straight factor. The idea is that because if something is very liquid, I could hold it for a really long time, it would add less and less. But the point here is that, again, we can sort of add things. The straight CAPM says, nope, it's only market risk premium, but there are extensions that account for other factors. And here's an example of one, which is liquidity. The last thing we want to talk about is, are these ex post alphas predictable? So if I regress historic return of a stock on the return of the market using my standard regression equation, if the CAPM holds, if it is true, if you were only compensated for market risk, I'm going to find some positive alphas, I'm going to find some negative alphas, but on average they should be 0. And I should not be able to predict the sign of the alpha using some other characteristic of the stock. But historically, you can. What we have found is historically, over long periods of time, the alpha on a set of smaller stocks is positive, and the alpha on a set of larger stocks is negative, meaning that small stocks earn more than the CAPM predicts, and large stocks earn less than the CAPM predicts. Similarly, stocks with a relatively low price relative to earnings, or price relative to EBITDA, or price relative to the book value, stocks that have a relatively low price, which are commonly referred to as value stocks, historically have had a high alpha, positive alpha, earning more than the CAPM says they should earn. And stocks that have a relatively high price to earnings, price to EBITDA, price to book, tend to have a negative alpha. And so stocks which are commonly called growth stocks tend to earn less than the CAPM says they should earn. The point is that evidence suggests that there are other things in addition to the market risk. And so later in chapter 10, we'll add more priced factors once we do a little bit more regression math. And recall, just because the CAPM doesn't tell us everything doesn't mean it tells us nothing, but there's fairly good evidence that just the market is not explaining everything, that there are other priced factors. And here's a story that indicates why that might be the case. And the last thing I want to talk about here is a dual hypothesis problem. A dual hypothesis problem is this. And this is a problem with all pricing models. Can I test the CAPM? Can I test to see whether the CAPM actually works? Is it the case that I can test to see whether or not stocks actually earn what they're supposed to earn? Well, the trouble is that for me to test the CAPM, I have to assume that the efficient market hypothesis holds. The efficient market hypothesis is that participants incorporate information in prices, then prices reflect information and expectations, and they earn what they should earn. So it might be the case that if I find that the CAPM doesn't hold, it's not that the CAPM is wrong, it's that the efficient market hypothesis is wrong. Or if I look the other way, if I want to test that prices are actually reflecting information, I have to do that within the context of a pricing model. So a dual hypothesis problem is that when you're testing the CAPM, you're also testing the EMH, but when you're testing the EMH, you're also testing the CAPM. And this is a problem not with just the CAPM, but all pricing models as you run into these dual hypothesis issues.